Welcome to our comprehensive guide on IFRS 9, Financial Instruments. This standard, issued by the International Accounting Standards Board, ISB, is essential for the accurate accounting of financial instruments. IFRS 9 aims to provide more straightforward classification and measurement of financial instruments. It replaces IAS 39 and introduces three primary classifications: amortized cost, fair value through other comprehensive income, DOSI, and fair value through profit or loss, FVTPL. The classification of financial assets is based on two main criteria at the entity's business model for managing the financial assets and the contractual cash flow characteristics of the financial asset. Let's dive deeper into each classification. Amortized cost. This category applies to financial assets held within a business model whose objective is to hold financial assets in order to collect contractual cash flows. Example: a company lends $100,000 at 5% interest per annum to be received annually for 5 years. The loan is classified at amortized cost because the company intends to hold the financial asset to collect the contractual cash flows. Every year, the company will recognize interest income of $5,000. Fair value through other comprehensive income, DOSI. This classification applies to financial assets held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. Example: a company holds a portfolio of bonds to collect interest income and occasionally sells bonds to manage its liquidity needs. This portfolio is classified as DOSI. Interest income and fair value changes are reported in other comprehensive income. Fair value through profit or loss, FVTPL. This designation applies to financial assets that do not meet the criteria for amortized cost or FDOSI. The primary intention here is trading. Example: a company actively trades shares of other companies. The shares are recognized at fair value with any profit or loss being recorded in the statement of profit and loss. Now, let's move on to the impairment requirements under IFRS 9. One of the most significant changes introduced by IFRS 9 is the expected credit loss, ECL, model. Under this model, entities are required to recognize expected credit losses from possible default events over the lifetime of a financial asset. The ECL model involves a three-stage approach for assessing impairment. Stage 1. Performing assets that have not had a significant increase in credit risk. Recognize 12-month ECL. Stage 2. Underperforming assets that have experienced a significant increase in credit risk since initial recognition. Recognize lifetime ECL. Stage 3. Non-performing assets that are credit impaired. Recognize lifetime ECL and interest revenue on the gross carrying amount. Let's look at an example to understand how the ECL model works. Example: a company holds a loan of $10,000 which has not had a significant increase in credit risk since initial recognition, Stage 1. Based on historical data and economic outlook, the company estimates the 12-month ECL to be $100. If in the next year, the credit risk increases significantly, Stage 2, and the lifetime ECL is estimated to be $600. The new ECL allowance is $600 minus the previously recognized $100, totaling $500. The criteria for recognizing changes in the credit risk of an asset are based on both quantitative and qualitative information, including forward-looking information. In addition to classification and impairment, IFRS 9 outlines hedge accounting principles to align accounting treatment more closely with risk management activities. There are three main types of hedging relationships: fair value hedge, cash flow hedge, and hedge of a net investment in a foreign operation. Example: a company expects to receive a payment in a foreign currency in the future and hedges this risk by entering into a forward contract. This is a cash flow hedge. The fair value changes of the forward contract are recognized in other comprehensive income and will be reclassified to profit or loss when the forecasted transaction affects profit or loss. The effectiveness of the hedge must be assessed at inception and on an ongoing basis to ensure that the hedging relationship meets the hedge accounting requirements. For a more visual understanding, Let's look at some data on companies adopting IFRS 9 and their impact on financial statements. These data points represent the changes in financial statements due to IFRS 9 adoption in various companies, demonstrating the substantial impact of the standard. Let's pause for a moment for a Q&A segment to clear any doubts. Q1. What are the primary classifications of financial assets under IFRS 9? 1. The primary classifications are amortized cost, fair value through other comprehensive income, FDOSI, and fair value through profit or loss, FVTPL. Q2. How does the expected credit loss, ECL, model differ from the incurred loss model? 2. The ECL model is forward-looking and requires recognition of expected credit losses from possible default events, whereas the incurred loss model only recognizes losses that have already occurred. Q3. In what scenario would a financial asset be classified as FDOSI? 3. A financial asset would be classified as FDOSI if it is held within a business model achieving objectives by both collecting contractual cash flows and selling financial assets. In conclusion, IFRS 9 provides a robust framework for the classification, measurement, and impairment of financial instruments, and its adoption can significantly impact financial statements. Thank you for watching. We hope this detailed guide on IFRS 9 helps you in your financial reporting. Don't forget to like, share, and subscribe for more financial tutorials.